Alright folks, grab your calculators because we're about to dive into one of the wildest valuations in tech history, Palantir Technologies, ticker symbol PLTR. Some people swear this company will run every government, every army, and probably your smart fridge by 2030. Others, they're screaming that it's trading at 600 times earnings, which basically means you're paying Ferrari prices for a bicycle with dreams. So let's break it down, because either Palantir is the next trillion-dollar AI giant, or it's just a very expensive PowerPoint with cool graphics. Palantir started out as a top-secret government contractor, building data software that helps intelligence agencies catch bad guys using algorithms. Now they've pivoted toward the corporate world with something called AIP, the Artificial Intelligence Platform. Think of it like ChatGPT for massive datasets, but instead of writing essays, it predicts which shipment will be late and which companies might go bankrupt the next quarter. It's smart, it's high-tech, and it's sexy on Wall Street right now. But smart doesn't always mean fairly priced. That's where the drama begins. Palantir earns around 30 cents per share right now, but the stock trades near $200. That's a price-to-earnings ratio of about 600. In simple English, investors are paying $600 today for every dollar of profit Palantir makes. If we apply a normal software industry multiple, let's say 30 times earnings, Palantir would need to make $6.67 per share just to justify its current price. Multiply that by roughly 2.5 billion shares and you're talking about $17 to $18 billion in net income. Today they make less than $1 billion. That's the gap. And that's why analysts are losing their minds. But here's the twist. Some investors couldn't care less about the math. They see Palantir as the ultimate AI infrastructure play, a company with government contracts, commercial clients, and a founder circle that screams Silicon Valley elite. They believe Palantir is building the backbone of AI for the modern world, something so valuable that the current earnings are irrelevant. To them, 600 times earnings isn't crazy. It's visionary. They point to Amazon, Tesla, and Nvidia, which were all once called overvalued until they weren't. In their eyes, Palantir is the next in line for that kind of greatness. Meanwhile, analysts are staring at spreadsheets having existential crisis. They see cash flow that's growing, sure, but nowhere near fast enough to match the stock price. They compare Palantir to other software companies that trade around 30 or 40 times earnings, and they're wondering how this one ended up at 600. It's like watching someone pay $10 million for a one-bedroom apartment because the view might appreciate faster. That's not investing, that's optimism with a caffeine addiction. Let's take a refresher. The price-to-earnings ratio is simple, price divided by earnings. If a stock trades at $100, and earns $5 per share, that's a PE of 20. Palantir trades at around $200 and earns about 30 cents. That's roughly a 667 PE. So you're betting the company's profits will rise at least 20 times over the next few years to make sense of today's price. The higher the multiple, the higher the expectation, and the smaller the margin for error. Let's test the math. If Palantir grows its earnings by 50% a year for 5 years, 30 cents becomes roughly $2.40 per share. At normal 30 times multiple, that equals about $72 a share. If they grow by 70% a year for 5 years, they'd reach around $5 per share. That's $150 at a 30 times multiple. To justify $200 today, they need to hit roughly $6.50 per share, which is the $17 to $18 billion net income mark. It's possible, but that's a Mount Everest climb in business form. Now, to be fair, some crazy valuations have worked before. Amazon once looked ridiculous on paper, so did Tesla, so did Nvidia. The difference is that those companies had clearer paths to scale and profits. Palantir has potential, but the execution risk is much higher. Government contracts are great, but they're not always predictable. And the corporate side of the business, while growing, still has to prove it can deliver that kind of cash flow. Listen, hope is not a business model. So this is where the war breaks out. On one side, the Palantir patriots, laser-eyed believers who think AI will rule the world and Palantir is the chosen one. On the other side, the spreadsheet soldiers, analysts clutching their calculators and muttering, "This math doesn't add up." It's faith versus fundamentals, the dreamers versus the data nerds. Both sides could be right, but not at the same time. Here's the lesson. Valuation is like gravity. You can fight it for a while, but eventually it pulls you back down. If you believe in Palantir's vision, fine, just don't bet your emergency fund on it. If you're a value investor, don't waste your energy arguing with people who buy based on vibes. They're not listening to your discount cash flow model, they're watching a highlight reel. Balance belief with math, that's the sweet spot. So what do you think? Is Palantir the future of AI and data security, or just another shiny overhyped story? Drop your thoughts below. I actually read the comments. If you got value from this breakdown, hit the like button, subscribe to Financial Watchman, and to support the channel, buy me a coffee at buymeacoffee.com/The Financial Watchman. This video is for education and entertainment, not financial advice. Always do your own research. Stay sharp, stay skeptical, and watch your finances like a hawk. I am the Financial Watchman, and I'm signing out. Bye-bye, y'all.